The people you assume are wealthy usually aren't, and the people who actually are, you probably don't know it. This is not an accident, it is a strategy, and it is the most consistently documented pattern across serious wealth research. The individuals who build lasting net worth almost universally do it quietly, incrementally, and in ways that produce no visible signal to the people around them. No announcement, no lifestyle upgrade, no content about it. The reversal is what makes this worth paying attention to. The financial behaviors most aggressively marketed as wealth building, the trading platforms, the crypto plays, the high-visibility investment strategies amplified across every financial feed, consistently underperform the boring, invisible moves that don't photograph well and don't generate engagement. What they don't tell you about building wealth is that the system rewarding visibility and the system rewarding actual net worth accumulation are running in opposite directions. This video is about the second system. The loudest people in any room about money are almost never the ones with the most of it. That sentence is not a platitude. It is a documented pattern. Thomas Stanley spent decades researching actual millionaires, not celebrities, not influencers, not the visible wealthy, and what he found was a profile so consistently unglamorous it never went viral. Used cars, modest homes in unfashionable neighborhoods, occupations nobody made content about. The defining characteristic of real wealth accumulation across study after study is the absence of performance. Performance is expensive, not just financially, though it is that. It is expensive in the specific way that matters most to compounding. It consumes the gap between income and investment. And that gap, sustained over time, is the entire mechanism. The 10 moves that follow are not secrets. They are behaviors, quiet, repeatable, unsexy behaviors that the visible financial ecosystem has every incentive to ignore because there is no product to sell alongside them. Move 1. Automate before you see it. The single highest leverage savings behavior documented across personal finance research is not a product, a strategy, or a mindset. It is timing. Money that moves to savings or investment accounts before it touches a checking account is money that never enters the psychological spending pool. It is never mentally available. It is never spent. The hidden connection between automation and wealth is that automation removes the decision entirely. Discipline fails under pressure. Systems do not. Every month that requires a conscious decision to invest is a month with a failure mode. Every month running on automation is a month that compounds regardless of what else is happening. Set the transfer. Size it slightly uncomfortably. Leave it alone. Move 2. Max the match before anything else. Employer retirement matching is the only guaranteed 100% return available to most people. It is also the most consistently underutilized financial tool in the American benefits package. Contributing below the match threshold is not conservative investing. It is leaving documented, contractually guaranteed compensation uncollected. The math does not have a counter-argument. Most people who are not maximizing their employer match are not aware of the exact threshold. They set a contribution percentage at onboarding and never revisited it. One conversation with HR, one adjustment to a percentage, and the return on that action begins compounding the following pay period. Move 3. The account nobody talks about. The health savings account is the only triple tax advantaged vehicle in the United States tax code. Contributions go in pre-tax. Growth is tax-free. Withdrawals for qualified medical expenses are tax-free. What most people get wrong about the HSA is the assumption that it is a medical spending account. It is an investment account with a medical spending option. After age 65, withdrawals for any purpose are taxed as ordinary income, identical to a traditional IRA. Before 65, investment growth is available for medical costs tax-free. The optimal strategy, for anyone who can manage it, is to invest the HSA, pay current medical costs out of pocket, and let the account compound untouched for decades. This is not widely discussed in financial content because there is no commission attached to it. It is available to anyone with a qualifying high-deductible health plan. It compounds quietly. Nobody posts about it. Move 4. I-bonds, and the inflation conversation. Nobody finished. The conversation about inflation in financial content peaked during the 2021 to 2023 window and then largely disappeared. The underlying problem did not disappear with it. Series I savings bonds, issued by the U.S. Treasury, backed by the full faith of the federal government, interest rate indexed to inflation, remain one of the most underutilized low-risk instruments available to retail investors. The purchase limit is $10,000 per person per year. They cannot be cashed in the first 12 months. After 5 years, there is no penalty. The reason they are underrepresented in financial content is structural. There is no platform taking a cut. There is no product being sold. You buy them directly from the government at treasurydirect.gov, set them aside, and they quietly outpace inflation for up to 30 years. That is not exciting. That is the point. Move 5. Tax loss harvesting. While nobody is watching, at approximately this point in the video, half the audience has mentally filed this under investing stuff I'll deal with later. That's the move. Stay with this one. Tax loss harvesting is the practice of selling investments that are currently at a loss to offset capital gains realized elsewhere in the portfolio, reducing the tax bill on profitable investments. It is legal, it is documented, it is built into most major brokerage platforms and handled automatically in several robo-advisor products. The mechanism: when an investment declines in value, selling it locks in a loss that can be used to cancel out the tax owed on gains from investments that went up. The sold position is immediately replaced with a similar, not identical, asset to maintain market exposure. The portfolio continues compounding. The tax bill shrinks. Across a 30-year investment horizon, the documented compounding effect of consistent tax loss harvesting runs into tens of thousands of dollars for a median-sized portfolio. It requires no market timing, no predictions, no risk that isn't already present in the underlying investments. It is one of the few genuine edges available to retail investors. It is almost never discussed outside of fee-based financial planning. Move 6. The raise protocol. Most people spend their raises before they receive them, not through lack of intention, through a well-documented psychological mechanism. The anticipation of increased income shifts the mental spending baseline upward before the money arrives. By the time the first larger paycheck clears, the lifestyle has already quietly expanded to absorb it. The move that consistently separates wealth accumulators from income earners is a single instruction given to the payroll or benefit system before the raise takes effect. Redirect the net increase, or a significant fraction of it, directly to investment. The lifestyle never upgrades because the checking account never sees the difference. The raise disappears into the future. Done consistently across a career, this single behavior compounds more dramatically than almost any investment selection decision. Because the best investment strategy in the world underperforms if the capital available to invest keeps getting consumed by lifestyle. Move 7. Own the index, ignore the narrative. The financial media requires daily content. The market does not produce daily insights worth acting on. These two facts are in direct conflict, and the resolution to that conflict is an enormous quantity of noise presented as signal. The documented long-term performance of low-cost index funds, particularly broad market index funds tracking the total U.S. market, or the S&P 500, consistently outperforms the majority of actively managed funds over 10-year or longer periods. This is not a controversial finding. It is replicated across decades of returns data and acknowledged even within the active management industry. The primary cost of index investing is boredom. There is nothing to watch, no story to follow, no decision to make after the initial allocation. The money enters, it tracks the market, it compounds over time. The primary benefit is identical to the cost. There is nothing to watch, no story to follow, and no decision to interfere with the compounding. The best thing most retail investors can do with a financial news notification is delete it. Move 8. The net worth number, nobody is tracking here, is the thing worth saving this video for. Most people track income. Almost nobody tracks net worth on a consistent schedule. And those are not the same measurement. Income is what arrives. Net worth is what stays. A household earning $150,000 annually, with $200,000 in consumer debt and no retirement savings, has a lower net worth than a household earning $60,000 annually, with no debt and $80,000 in index funds. The first household looks wealthier from the outside. The second household is wealthier by every financial measure that compounds over time. The move is simple and takes 11 minutes once a month. Total assets minus total liabilities equals net worth. Track the number. Watch it move. Let the movement of that number become the metric that financial decisions answer to, not the income figure, not the lifestyle visible to others, not the account balance on any single day. When net worth becomes the number you manage, every financial decision reorients around it automatically. Move 9. Debt sequencing, not debt elimination. The advice to eliminate all debt before investing is mathematically incorrect in most cases. The advice to invest while carrying all debt is also mathematically incorrect in most cases. The correct behavior is sequencing, and sequence depends entirely on interest rates. Debt carrying an interest rate above 7 to 8% is a guaranteed negative return. Paying it down is the equivalent of earning that rate tax-free on whatever is paid. No index fund offers a guaranteed return. High-interest debt repayment does. Priority goes there first. Debt below 4%, a mortgage in a low-rate environment, a subsidized student loan, may carry an interest cost lower than the long-term expected return on broad market index investment. Aggressively paying this debt down, while foregoing investment, is potentially costing money over a 30-year horizon. The number that determines the sequence is the interest rate on each debt compared to the realistic long-term return on the alternative investment. That comparison, run once per debt, generates the correct priority order. Most people have never run it. Move 10. The conversation that compounds. The final move is the one that produces no immediate financial return and the highest long-term one. Wealthy people, the genuinely, quietly wealthy, not the performatively wealthy, talk about money differently than people who are not building it. They discuss mechanisms, returns, structures, sequencing decisions. They are specific in ways that feel uncomfortable in most social contexts, because most social contexts treat money as either a taboo or a status signal, with nothing in between. Finding one person, who is willing to have the specific, unglamorous, numbers-forward conversation about what is actually working in their financial life is worth more than most courses, most content, and most advice columns. Not because they will tell you what to buy, because the act of having a real conversation about real numbers forces a specificity that vague financial intention never produces. The people building wealth quietly are almost never doing it alone. They are doing it invisibly. Those are different things. The uncomfortable truth this video lands on and does not resolve cleanly. Every move on this list is documented, accessible, legal, and available to most people reading this right now. The gap between knowing these moves and executing them is not information. The information has existed for decades. The gap is something else. And it is the subject of the next video on this channel, the one that goes into the specific psychological mechanism that makes people close the brokerage account tab before they finish opening it. This channel does not package financial mechanics into lifestyle content so they're easier to market. The math is the content. If that's the version of money education you were never given and have been looking for, subscribing costs nothing, and the next video picks up exactly where this one stops being comfortable. Share this with whoever in your life earns well and has nothing to show for it. Not as a judgment, as a question. Because the 10 moves on this list are not complicated, but nobody handed them out at the beginning. The question worth leaving in the comments: which of these 10 moves have you been aware of for more than a year and still haven't done? And what's the actual reason? Not the stated reason, the actual one. Because the answer to that question is more financially useful than anything else in this video. Here is the delayed bomb. The wealthiest person you personally know is almost certainly not who you think it is. They drive something ordinary, They live somewhere you would not expect. They do not talk about it. They have been running these moves, or versions of them, quietly, for longer than you have been watching financial content. They did not find a secret. They just stopped performing and started compounding. And the distance between where you are and where they are is almost never as large as it looks from the outside. It is almost always a sequence problem, and sequences can be changed.